Hey everybody, and welcome to our video on setting stops and limits. We go over this in nearly every video in which we describe our entries or go through the entries, so you can check out the entries playlist. And as always, just a reminder that I leave my contact information in the video description of every YouTube video, so feel free to reach out to me with questions or leave a comment. And let's get into it. So, first of all, always place your stop upon entry. I know that this is something I say over and over again. I know it may seem pointless. I know it may not be something that you do. I know some of you don't. I have made this mistake of trying to trade without a stop when I was learning. I have not set my stop right when I entered, and I've forgotten to set one and come back and look at my account later and realize that I don't have the right words. I don't have PG words, but it's not good when it happens. Place your stop right when you enter. And at a lot of prop firms, you can't enter a trade without a stop. They won't let you. And there's a reason for this. So we're placing our stop when the pattern rejects. And we'll go over this in some charts here in just a second. But the idea is if we're trading a breakout, for example, we want to place our stop in a place where if price comes back to there, it probably means the break and retest isn't happening. Or we're placing a stop just outside a trend channel. If price goes out that way, it probably means price isn't staying in the trend channel and taking the bounce we thought. So we'll go over what that actually looks like. Then we'll go over the TP1 at 1 times the risk and TP2 at 3 times the risk. So if our stop is 100 pips away, TP1 would be 100 pips away, and TP2 would be 300 pips away. We'll also go over why you may want to move stops and limits. We move stops when TP1 is hit. We'll move our stop to entry. And sometimes we'll move our limits based on the price kind of leading into our setup. And we'll talk about that and whatnot. But first, we're going to go into some math of why we use this kind of one-to-one risk to reward with TP1 and then the 3 times risk for TP2 and how it all works out and benefits us before going into some charts. Okay, so let's talk about why we do this with our take profits and our limits, basically. So on this page, you can see my crappy drawing of a long trade. Obviously, price never moves that smoothly in our direction, but it's just an example. So we have our entry there at the bottom green line. Then the next one up, the middle green line, would be TP1, and the highest one would be TP2. Now, for argument's sake, let's say that we're risking $100 on the trade, $1 per pip. Our stop is 100 pips away, and it would be $100 if price went to stop, negative 100. So our TP1 is then 100 pips away, the same distance away our stop is. As price moves up to TP1, we would be $100 positive on the trade. Now the number you see on the right is how much we're taking. We're taking $50 off. We're taking half of the trade off. We've booked $50 profit and our stop is now at entry, meaning the very worst we'll do is walking away with $50. It's $1 a pip, it moved 100 pips. Then it moves a total, including that first 100, of 300 pips, which if we had the whole position open would be $300. But we only have half the position open at this point, so it's about $150. When price hits that, what we end up getting is $150 plus the original $50 we got. So we end up getting $200. I know that I say let's use a 3-to-1 risk to reward ratio. How this plays out when we get TP2 is an actual 2-to-1 risk to reward ratio. And I know it seems crazy because if we left the whole position open, we would have 50% more profit for risk. The problem is not all trades are going to go all the way to TP2. Some trades play out in our favor slightly for a few hours and then come back and go the opposite way. So that's why we take that TP1. In this example right here, it's $1 a pip up until TP1, and then it's 50 cents a pip. So at 300 pips, we close another 150, the position's closed, and we've collected $200 while risking $100. So let's do a little bit of math on this. We're going to go with 10 trades and the $100 risk. So let's say in this example, 5 of them just went straight to stop. That's negative $500. 3 hit TP1. It's $50 each back to entry. Means nothing further. So each one's $50 or $150 total. And 2 go all the way to TP2. That's $200 each or $400 overall. That means we made a net of $50. That's only a 50% win rate, and we're still turning a profit. You can see why this relatively strict risk to reward works out. Let's move on to the next example. Let's say 4 hit stop. So we have a 60% hit rate. That's negative 400. 3 hit TP1 again, so that's plus 150. And 3 hit TP2. Suddenly we're positive 350 instead of breaking even or something. That's a 60% win rate. What we're aiming for is more trades to hit TP2, obviously. So let's look at one last example. 6 of our trades hit stop, meaning we're at a 40% win rate. Only 40% of our trades are netting us a profit. So that's negative $600. 1 of them hits TP1, that's positive 50, and 3 hit TP2, our final limit. That's positive 600 for a total of positive 50. So one of the benefits here of trading with a 1-to-2 risk to reward ratio like this is we don't need to be right 80% of the time to turn a profit. Generally speaking, with appropriate risk to reward like this, a solid 50% win rate will actually be profitable. It may not make the money that you want to see. It may not make enough to join a prop firm necessarily, but with proper risk management, 50% win rate can absolutely make you a living. It can make you decent money, especially if you have a sizable account. So it's important with this risk management, and it all works together, to recognize that the solid risk management helps protect you. You don't have to worry when you lose 3 trades in a row or 3 trades out of 10. You're still going to be turning a profit. We're going to go into some charts and look at how to actually do it. But I think this is really important to remember and to look at, especially when we're kind of worried because we're in a losing trade. It's not about one trade. Don't just close the trade for no reason because your emotions have had enough. Remember that you only need basically a 50% win rate in order to turn a profit. You only need a couple trades to hit TP2 in order to balance out the losers. Each TP2 is twice what a loser is. So even if you had 6 straight to stop, that'd be negative $600. And the other 4 went straight to TP2, that's positive $800. So really keep this in mind, that with the appropriate risk to reward or risk management like this, you really don't need a huge win rate. Yes, you should always strive to take better entries and stop taking the entries that aren't working. But remember that it's the risk to reward that kind of acts as your foundation that allows you to keep trading and turning a profit even when there's losing trades in the mix. All right, so let's look at some charts. I am not going to go over in depth what these entries exactly are, but I am going to just mention them if you want to look at the videos for those. So this is a break and retest, right? We have a channel, price broke out, retesting it, and it bounced. So our entry would be somewhere around there. That is not visible. Our entry is that candle, and we'd want our stop below this little swing low. If it breaks down below that, it's probably coming back into the range, and there's no reason for us to stay in it. So we want our stop down there. So I'm going to use the long position tool here. We're going to drag it out so it's not in the way. That's our entry right there. We'd want our stop. I'll move a little farther so we can see. We'd want our stop down here. I usually don't place it right at the base because sometimes it will come down and retest it or even perhaps go a bit further. So I give it a little bit space, especially on New Zealand pairs, because the spreads can get pretty wide at market close. And we're going to want our TP1 at 1 time the risk to reward. And you can see it right here on TradingView, risk to reward ratio. So if I just drag that down, we get a 1-to-1 risk to reward ratio right about there. That's 77.41. So that would be our TP1. When price hit TP1, we would then take our stop and move it. So I'm actually just going to mark TP1, mark entry, and mark our stop. And then our TP2 will be at a 3-to-1 risk to reward ratio up here. And I will put another line up there. So that's what our trade would look like. We would enter here. It's a little low, but we would enter there. Our initial stop would be down here. Our final take profit would be up here, and we'd set a sell limit right there. That's a 1-to-1 risk to reward ratio and 3-to-1 for the final one. So as price moved up, and I'll actually go to bar replay. All right, so this is a great tool on TradingView. I think you might have to pay to get it. Not entirely sure. Bar replay it's called. It's fantastic. So we're gonna actually play it back. So there's the candle where we entered. There's our stop. And boom, price hit. I mean, it would have hit mid candle. Price hit our TP1, which means we closed half our trade. At that point, we would take our stop and move it up to entry. That means, say we collected $50 on that. If price came back down here, the trade would close, we'd be out of it. We'd have taken our $50 and be done. If it keeps going, great, we can take TP2. So we'd hold this and it would have hit right there. That was a pretty fast one. That was a good trade. I always love the ones that move that fast. And boom, we're out. I don't really care, people often ask but it kept going up after. Great. The reason I use 3-to-1 is because I personally poured over the data with the entries I took and tried to decide the best number to maximize profit, and back tested with 2-to-1, with 4-to-1, and so on. And 3-to-1 is about where it's most profitable. So there's that one. Here's this one. I'm going to delete that line because it's kind of messy. And I'm going to move us over to the 1-hour chart where I took this entry. Price formed a little bit of resistance here, hit a little bit of resistance. Then we came down into it, didn't really get a perfect reversal candle or setup there that I liked. And then boom, there we did, a big engulfing candle. So again, we're going to want to go long somewhere right there. Our stop should be down below this candle, so somewhere, again, crooked down there. And it's a long position. So let's line that up. And we'll line this one up down here where we want it. And it looks like 1-to-1 would have been about, we would have gotten it over here. And I'm going to scroll out and move this a little bit. And then we want to set our final target is 3-to-1. And I'm going to draw a big line for this one. Whoops. In that range. So let's get rid of this. So again, just using the bar replay mode. This one I'm going to go a little bit faster because it looks like the trade took a little bit longer, right? More candles. So we would have entered there. On that one is where I entered. My stop's down here, my take profit set, and I have it set to close half my position at TP1. And lots of kind of jagged movement, kind of hovering down between my stop and entry, hovering between my TP1 and entry. just hugging my entry essentially. And then boom, we hit TP1 there. So price moves up, beautiful. And it takes some time, but it eventually gets there, I believe. These can be scary ones where you're holding and afraid you're going to lose your profit. But with some discipline, you can hold. And here we go. And there it is, TP2. So at that point, we're out of the trade. It's done. If we risked $100, we made $200. Now I'm going to go over and show you one that actually hits TP1. This is a real trade I took that hit TP1 and came right back to stop. So again, we have a trend channel with a breakout and retest. Breaks out here, comes back and retests. Entry is right about there after that bullish candle. Stop would be down here. It's a crooked line, but that's okay. So let's put this tool in and we'll make that 1 to 1. So our TP1 is there and our TP2 doesn't matter in this case because I'm showing an example, but it's farther up there. So what happened on this one is what happens to a lot of trades. Nothing to be bummed about. There's still a profitable trade. We would have entered, I'll slow this one down ever so slightly. So we would have entered off that candle, set stop down here. I actually might have spaced that down a tiny bit because the US dollar Mexican peso has wide spreads, which would mean our take profit was slightly up if I moved my stop. But 1-to-1 risk to reward ratio. Price did just a little bounce and hit TP1 there. So at that point, we're moving the stop to entry, right? We have our stop loss is now right where we entered. And very quickly, it came right back through it and we were out of that trade. So if you were risking $100 on that trade, you made $50, maybe minus a spread, but about $50. So that's how we move our stops and limits and how we set them. The way that I do this, and I've explained this in other videos, is I use TradingView, and I don't use, it's all paper trading. I don't use TradingView actually connected with my broker or any of my brokers at all. But what you can do, and this is probably a bad one to use, let's use the Kiwi Yen. So say we want to, let's go to a daily chart. Okay, say we want to buy here at 77.85 roughly. And we want to set our stop down here at, I'm just going to call it 77 to be easy. TradingView will tell me that's 86 pips. So you can remember that number, or you can do what I do. You'll set your risk to whatever your risk is, say 2% max. You'll set your take profit, and what I do is I type in 86 there, so this matches with this. And I take this number, which is obviously moving because price is moving, and I copy it. No, I don't usually right click and click copy. I just did that to show you. Usually I Control C, but I copy it. Then I take this number 86 and multiply it by 3 to get my 3-to-1 risk to reward ratio. So 86 times 3 is 258. I hope that math was right. Oops. So there's my entry of stop at 77, take profit at 80.44. That's a 3-to-1 risk to reward ratio. I'm risking 2%, so it set it to that, and I would buy. And boom, there it is on the chart. Now for my TP1, I take that number I copied. It's going to be somewhere up here. I right click, trade, and do a sell limit. So I just paste that number in. I cut the units in half because that's the amount of units I have, roughly 4,050. So that'd be 2,025 is half. And I put a sell limit there. That's it. Now in this example, it's actually a good one. Because of that swing high, we have to be willing to move our limits and not get an exact 1-to-1 or 3-to-1. So because it had a swing high here and was, if you scroll out, that was the highest it's been since 2000, whatever, late 2019, roughly. So it's kind of a little risky if your TP1 is up here, perhaps. So I might put it like right there, just to be safe and make sure I get it. Because there is a possibility that price is going to hit this area and bounce back down. So I know I say this 1-to-1 risk to reward ratio and 3-to-1 with the final take profit, but you also have to be willing to move stuff. I believe there was a good example here in the pound Swissy. Somewhere on the 1 hour. Maybe not. I think I took a breakout down here. Yeah. Where price was doing this, and then it came back and retested it. And I will just show you. So there we got this retest of this previous area, and we got some candles here. I took it there. I had my stop set just below those candles, and we can see that the 3-to-1 risk to reward ratio is right about there. I'm gonna zoom out and drag this away just so we can see where that is. Whoops. So with this trade, the risk to reward ratio, I might have set my stop wider, that's what it was. So on this trade, I had a little bit of a wider stop because I thought it might come down and test this a little bit harder because of where the moving averages were. And you can see that my final take profit is above this little swing high. So what I would actually do if I were trading this, when I did trade this, is I would move my final take profit down so it coincides with the top here. So instead of a strict, if I'm entering here, I put some space in my stop because this really tested. Like if you look at the line of where my crosshair is, it really tested over here. I thought there was a possibility it may test even further, especially with the situation with the moving averages. So that's why I set a wide stop on that one. Now I don't want my final take profit up there at 3-to-1, which it would have hit, but it's a little bit risky. Instead, I put it right there, right where it's even with that previous swing high. It's much safer. Yes, you're leaving some profit on the table, but there are enough times that I've seen price go up to that swing high and come right back down to entry, and then you're losing more profit. Those extra, little bit, maybe extra however many, 20 pips, it sucks to lose that, but it sucks more to lose the 100 pips when it falls back down. So be smart with where you set your limits. If you do the math and your limit comes out right here, don't be afraid to move it a tiny bit closer. It's up to you. It definitely takes some discipline and some discretion on your part. But that's it. That's how I set my stops and limits when I enter a trade, regardless of the setup or the entry that I'm taking. So just to touch on everything one last time before this video is over, set your stops and limits immediately. I showed you how I do it. You can do it however you want. There are pip calculators out there for free. You can just do the math in your head, look at the pips. I have a calculator on my desk at all times, an old school calculator. But set those stops and limits immediately upon entering. When TP1 is hit, move that stop up to entry. I know that it can be rough to have a TP1 hit, stop, it comes back to stop and then keeps going our direction. Is what it is. Be wise with your limits. Don't be afraid to move it or to set it somewhere Maybe that's not quite 3 to 1. Sometimes I might go slightly over 3 to 1, but definitely don't be afraid to move it down below 3 to 1. And finally, remember that math that we went through. That it's not about one trade, and I think that's something that we can get caught up in, looking at this one trade and what's happening or whatever. And I really think that what's important is to remember that it's a bigger picture. If we lose one trade, it's not the end of the world. It doesn't need to be the end of the world. It's about statistically, if I take this entry 100 times, how many times are we going to win, and so forth. So keep that risk to reward, keep that discipline, and just remember that it's not about just I'm not saying don't pay attention to each trade, but really try to make an effort to remember it's about the bigger picture and set that risk to reward wisely and be patient.